Hey everyone, welcome back to Corporate Decoder. Today, XWELL Incorporated just filed a current report on Form 8K, announcing a major sale, and I am seeing a big shift in strategy here. Quick note, this is not financial advice, just my take on public filings for educational purposes. The company is selling off two of its key businesses, and this could completely change its future. Alright, let's break down what XWELL Incorporated announced on the 6th of July of 2026. Essentially, they've entered into a purchase agreement to sell off two of their main operating units, XpresSpa Holdings LLC, which is their airport spa business, and XpresTest Inc, which is their biosurveillance and testing operation. Now, XWELL Incorporated is keeping its health and wellness retail locations that are not in airports. Everything else, the airport spas and the testing services, is being sold. This sounds like a pretty significant divestiture. So, how much are they getting for this? The buyer is paying a base purchase price of $13 million. This price can be adjusted after the deal closes based on things like working capital, any debts the company has, and the cash on hand. A portion of this purchase price, specifically $2,650,000, will be held in escrow for a while. This is standard practice to cover any potential price adjustments, or if XWELL has to pay out for something later on. This filing also mentions what happens to certain stock awards in XpresTest. At the closing of the sale, any outstanding restricted stock awards for XpresTest will become fully vested. They will then be either cancelled or bought back by XpresTest for a cash amount. This amount will be based on a valuation that the buyer and XWELL agree on. It means employees with these specific awards in the XpresTest business will get paid out as part of this sale. Now, in any big deal like this, there are always a lot of promises and guarantees. The purchase agreement has standard promises from XWELL about the companies being sold, and promises from the buyer too. It is their way of making sure everyone is on the same page about what they're buying and selling. There are also agreements on how the company should operate between now and when the deal actually closes. XWELL has agreed not to seek out other deals, meaning they can't shop the business around to other potential buyers. This is a no-shop clause. However, there are exceptions. If XWELL gets a proposal that is significantly better than this current deal, and their board believes it is in the best interest of shareholders, they might be able to consider it, but it is a complicated process with specific rules. A really important point here is that XWELL shareholders need to approve this sale. This means a vote is coming up, and the company will be filing proxy materials with the SEC soon to get that approval. Without shareholder backing, this deal won't happen. For the sale to be finalized, several conditions need to be met. These include no legal actions preventing the deal, the shareholder approval we just mentioned, all the promises made in the agreement holding true, no major negative changes for the businesses being sold, and getting certain approvals from other parties. This is a crucial detail. As of the signing of this agreement, the buyer has not yet secured all of the financing they need. They've stated they believe they will have the money, but it is not fully locked in yet. The good news is, the buyer has committed to closing the deal regardless of whether they get the financing. This means their obligation to buy is absolute, even if their financing plans fall through. This is unusual and signals confidence or perhaps a high degree of commitment from the buyer. Like any contract, there are ways for the deal to be called off. Either XWELL or the buyer can terminate the agreement under specific circumstances. For example, if the sale isn't completed within a certain time frame, which is 180 days but can be extended. There are also provisions for termination if a government stops the deal or if shareholders don't approve it. XWELL can also walk away if the buyer breaches the agreement or if XWELL accepts a better offer. Here is where it gets interesting. If XWELL backs out of the deal under certain conditions, like changing their recommendation to shareholders or accepting a better offer, they might have to pay the buyer a termination fee. This fee is set at the higher of $1.3 million or $650,000, plus the buyer's expenses, with a cap on those expenses at $2 million. On the flip side, if the buyer breaches the agreement or fails to close the deal even when all conditions are met, they might have to pay XWELL a similar termination fee, also calculated as the greater of $1.3 million or $650,000 plus expenses, capped at $2 million. It is a form of protection for both sides. Adding another layer, the parent company of the buyer, FaceHouse LLC, has provided a limited guarantee. This means if the buyer doesn't pay the seller termination fee or other amounts owed, FaceHouse LLC guarantees those payments. Their total liability is capped, but it provides XWELL with more assurance that they will receive the agreed upon payments if things go wrong on the buyer's side. The agreement also includes standard indemnification clauses. This means if there are issues related to the businesses sold, one party might have to compensate the other. For general problems that aren't fundamental to the deal, like breaches of guarantees, there is a cap of $2 million. The buyer has to go after money from the escrow account first before making direct claims against XWEL. To help ensure this deal goes through, key people at XWEL, including board members and executive officers, along with American Ventures LLC Series X-Exportive XWEL, have signed support agreements. They've agreed to vote their shares in favour of the sale and against any competing offers. There are also plans to sign a transition services agreement, which will outline how services will be provided during the handover period, and an escrow agreement with Citibank. This shows they are thinking about the practical steps needed to finalize the transaction. Alongside this filing, XWEL also issued a press release on the 7th of July 2026 announcing this deal. This is common practice to inform the public and investors. Now, the filing includes a standard section on forward-looking statements. This is basically a legal disclaimer. It warns that statements about the future, like the timing of the sale, expected benefits, or the ability to close the deal, are based on current expectations and could change. They're saying things might not turn out exactly as planned due to various risks and uncertainties. They detail risks like not getting shareholder approval or unexpected problems that could stop the sale. They also mention the company's ability to manage its remaining business after the sale. This section is essentially saying that this report is not an offer to sell stock or a solicitation for you to buy stock. It is just a disclosure of information about the agreement. They are also reminding everyone that more detailed information will be coming. Specifically, they plan to file a proxy statement with the SEC regarding the shareholder vote. They stress that investors should read this proxy statement carefully when it becomes available, as it will have crucial details about the sale and related matters. This part explains that the company's directors and officers might be considered participants in asking shareholders to vote for the deal. Information about these individuals and their interests will be included in the proxy statement. Finally, this section lists the exhibits filed with the report. Most importantly, it includes the purchase agreement itself as Exhibit 2.1 and the limited guarantee as Exhibit 10.1. So what does all this mean for XWEL Incorporated? They are essentially selling off their airport hospitality and testing divisions for $13 million. This comes after news headlines in July 2026 about their stock soaring, with one report specifically mentioning the sale of these businesses for $13 million. It seems like a strategic pivot, moving away from these businesses to focus on the retained ex-airport operations. The fact that the buyer hasn't fully secured financing but is still committed is a major point of interest, as is the significant termination fees outlined for both parties. For XWEL, this sale could free up capital and allow them to streamline their operations, focusing on the remaining health and wellness retail locations outside of airports. The risk I am watching is whether the retained business can be successfully grown, and if the $13 million sale price provides enough capital to do so effectively. What I am actually looking for is how the company will report its financials after shedding these businesses, and if the remaining operations can achieve profitability. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If you found this analysis helpful, please like this video and subscribe for more deep dives like this, and join our community by clicking the link to our Discord in the description.